So in this video we're going to put a couple of buzzwords on the back of what are futures. Now if you already get what futures are all about, that's fine. We're going to go straight in here and just explain a couple of extremely common bits of jargon, especially if you're into commodities, but actually applicable elsewhere as well. If you're not comfortable with basic futures, or you just think you'd like to understand basic futures first, do see my video, What Are Futures? Okay, so let's leave all of that to one side, and we'll assume you're comfortable with the basics of a futures contract. Here's the point, and here's why these two bits of jargon are so common and popularly used. Right, basic question. If I was prepared to sell you a ton of aluminium right now, let's say for $2,500, here's my question. If you want it in 3 months, or 6 months, or a year, not now, you don't need it now, should I charge you more or less than the current market price to ship it to you in 3 or 6 months or a year? And the answer is I should charge you, and I will charge you more normally. And the reason is this: if you want me to sit on, not literally obviously, if you want me to keep a ton of aluminium for you for 3 months, or a ton of cocoa, or some head of cattle, or copper, if you want me to sit on a commodity for 3 months and then deliver it to you, in the meantime I'm going to incur what are known as costs of carry. In other words, I have got to presumably insure the stuff, store it somewhere. That's going to be like a warehouse presumably, and what if that warehouse burns down, or the ship sinks, or whatever it happens to be. And in the meantime, for as long as I'm holding a ton of this asset for you until you want it, I can't have my money in the bank. I'd like to sell it now, cash in and stick my money in the bank and earn some interest, but I can't, because I've got to sit on this ton of whatever it is until you want it. And the problem with aluminium, as you might have noticed, is it doesn't pay interest. Neither does gold, and neither does copper. It's kind of a dead asset in that sense. So here's the point. A normal market in futures is Contango, as they call it. Strange word. It just means this: the price for delivering an asset in the future is higher than the price for delivering it now. Okay, so if you were to sort of plot that on a graph, don't have to obviously, if you were to plot that on a graph, there's time and there's price. And very simple, here's now, there's 3 months time, and there's say 6 months time. In a Contango market, you know, there's sort of $2,500 for argument's sake. In a Contango market, that tends to be the relationship, and the only reason I've drawn a graph is just to show that relationship nice and simply. In other words, the price for future or forward delivery in 3 months is higher than it is now, so $2,600, and the price for 6 month delivery is higher still, and the price for a year's forward delivery will be higher still, right? And the reason is that the further out you want delivery as the buyer, the longer the seller in theory has got to keep the asset, keep it safe, and so on, and is not going to be earning interest on that money, and therefore the more they're going to charge you. So typically when you look up the price of a futures contract for delivery of an asset in say 3 months time, you'll find it's slightly above, depending on the asset, the price of what's called the cash asset in the market today. That's if you wanted to buy it at the metals exchange for sort of immediate delivery, let's say. All right? And that relationship where futures prices are above today's prices, if you like, is known as Contango, and that's the normal state of affairs. However, it is possible, normally it doesn't last that long, but it is possible in the commodities market, for example, for the market to enter what's called backwardation. It literally goes backward. And that, you might be able to guess, is where, if I was doing it on a graph, you'd have a situation that looked more like this. Okay, and all that shows you in one simple way, if you like, is that the price of the asset now is actually above the price for 3 months forward delivery or 6 months forward delivery. That's a bit weird, because based on what I've just said, that shouldn't normally happen, should it? We just agreed there's normally some sort of little premium for forward delivery. So what would be happening there? Well, normally it doesn't last that long, because it is a sort of seem to be an abnormal situation, but you get that in commodities markets, for example, where there's a sudden demand surge for the asset itself. You know, an oil crisis, for example, could provoke this sort of reaction, because suddenly there's a huge premium on having the stuff out of the ground and stored safely. All right, and that sort of outweighs, if you like, the costs of carry considerations I just mentioned. There's almost a benefit to carrying the asset, not a cost to carrying the asset. Okay, and that creates what's called a backward market, and it tends to, if you're seeing at the graph, it drives the line that way, flips it over, and it just says that for now, all right, the cash asset is actually valued more highly than the same asset for delivery at some unspecified point in the future. So there we have it, a couple of very common bits of jargon in the derivatives market. Contango then is the situation where the price for forward delivery is above the cash price, the gap being those costs of carry, typical costs of carry, storage, particularly on perishable assets, like cocoa and sugar and so on, insurance, and lost interest on the money that could be in the bank if you're the seller or supplier. Backwardation can happen, it's less common, it doesn't last as long, and it's often down to what I'd call special supply-demand factors affecting the cash price of the asset in the market.